Welcome to the Deep Dive. Today we're digging into a really interesting company, Hindustan Construction Company, HCC. This is a name that's basically built huge parts of India's infrastructure. We're talking massive, really strategic projects. But, well, right now, things are complicated. You've got this incredible operational history, a massive order book, sure, but that's clashing with the stock just kind of sitting there, a really high valuation and significant debt. It's like a tug-of-war. So we've pulled together three key things: a detailed technical stock chart analysis running right up to this month, October 2025, the latest news headlines covering contracts and, well, some volatility, and their Q1 FY26 analyst presentation. We're trying to synthesize it all for you.
Yeah, our mission really is to figure out what does this all mean behind the headlines and the chart noise? How does a company known as a nation builder since 1926 reconcile that huge reputation with high debt, the stock chart that's basically neutral, and even some big leadership changes recently?
Exactly. How do you square that circle? Let's dive in. Okay, let's start with the market side, the stock chart.
Yeah.
Because it really tells a tale of wild swings followed by just patience. Looking long-term, say from 2021, HCC basically went sideways for ages, right up till mid-2022. Then bang, the rally started, it was powerful, pushed the stock way up, hitting nearly, 55 rupees in mid-2024?
Mm-hmm.
But since that high point, there's been a pretty big pullback. Now, October 2025, it's sort of stabilized around 28.85 rupees.
Mm-hmm.
And the good news, technically speaking, is it's holding above that crucial 200-week moving average. That's often seen as the long-term floor for investors.
And that stability, that's precisely what the shorter-term indicators are screaming right now. You look at the weekly RSI, the Relative Strength Index, the 14-week one, it's at 49.89. That's textbook neutral, just equilibrium.
So not overbought, not oversold, just sitting there.
Exactly. It's not a signal to rush in or bail out. It feels like the market's just holding its breath, waiting. And we're seeing lower trading volume recently, too, which just confirms this stabilization phase.
Right. The technical picture really suggests more sideways movement is likely. The stock seems to be waiting for something, a catalyst, a big contract win maybe, or a major claim getting resolved, something to kickstart the next move.
Okay, but here's the bit that really jumped out at me, the thing that highlights the sheer risk involved here.
Yeah.
If you track those huge ups and downs from 2021 right through to now, October 2025, the total net change on that chart, it's only about 9.15%.
Wow.
Yeah. All that volatility, peaking near 55, dropping back, and it's barely moved net-net over that specific period.
That is just wild volatility, isn't it? A crazy ride just to end up almost back where it started. But then you zoom out, look at the 5-year cumulative return, and it's a totally different picture. That's a huge 461%.
Massive long-term game.
Phenomenal long-term growth, yeah. But it contrasts so sharply with the short term. That negative 1-year return is substantial, like minus 27% and maybe minus 44%. You really need a strong stomach for those kinds of swings. Definitely. So those key levels are important if things do start moving again. Support seems solid near that 200-week average where it is now. But the ceiling, the resistance, looks pretty thick up in that 40 to 55 rupee zone where it peaked before.
Right. So the technicals say wait and see. But
Okay.
if you look at what the company's actually doing on the ground, well, they're not waiting at all. They're busy building some seriously major projects across India. And we really have to stress the scale here historically. HCC built 60% of India's installed nuclear power capacity, 60%, and 26% of the hydropower capacity. These aren't just, paving roads. These are highly complex strategic energy assets. Not many companies can do this stuff.
And that legacy of big projects seems to be carrying through. Despite all the market uncertainty we just talked about, their current order backlog is solid. It's at 11,188 crore. That's revenue already booked, basically. And looking forward, the bid pipeline is huge, estimated around 40,000 crore. That suggests pretty strong business momentum, right? Lots of potential future work.
Yeah, absolutely.
And we've seen some wins recently confirming that. There was that 204 crore contract from Hindalco for an aluminium smelter expansion in Odisha. And that's on top of those big Patna Metro contracts they won earlier, worth over 2,500 crore.
Mm-hmm. And the Q1 FY26 presentation really highlights some concrete operational achievements, too. Like the Anjikat cable stay bridge, the Prime Minister inaugurated it back in June 2025. This thing is India's first cable-stayed railway bridge. Big 193-meter pylon. It just underlines the kind of complex, non-standard work they tackle.
Okay, those are definitely impressive projects. But I have to ask about that 40,000 crore bid pipeline. I mean, that's massive potential revenue, yes. But doesn't bidding on and executing projects of that scale require enormous upfront capital? Doesn't that risk making their current debt situation, which is already high, even worse?
That's a really sharp point. It absolutely is a double-edged sword. Winning big contracts is great for future revenue visibility, yeah. But the capital needed upfront, especially for projects needing specialized gear, definitely puts pressure on the balance sheet. Like, take the Vishnugad Pipalkoti hydro project they mentioned. They've done 6.5 kilometers of TBM mining already.
TVM, tunnel boring machine, right?
Exactly, tunnel boring machine. That's the hugely expensive kit you need to carve tunnels through rock. Doing these projects means heavy investment in that kind of machinery, and yeah, that feeds right into the debt structure. They're proving they can do the work, sure, but it comes at a significant financial cost.
Okay, so this brings us right to the heart of the paradox, doesn't it? We've got undeniable operational muscle, huge future potential in that pipeline. But how does all that nation-building work square with the, frankly, tough annual financials and the market's current view of the stock? Because the annual performance for FY25, well, it wasn't great. The recent numbers showed overall revenues and profits were down year on year. Consolidated net sales dropped to about 5,726 crore, and net profit took a significant hit compared to the previous year.
Right, and this is where those Q1 FY26 results get really interesting, really paradoxical. Because while their main operational income, consolidated income from operations fell sharply, like almost 40% year on year, the bottom line consolidated profit after tax saw this massive positive swing. It went from a loss in the previous period to a 50.7 crore profit.
Okay, wait. Operations down nearly 40%, but profit up significantly. How does that work?
Well, the key seems to lie in their liabilities and, crucially, these old claims. The company's carrying substantial gross debt, around 3,490 crore. But they also have this huge potential asset on the books. Arbitrational exposure, basically claims under dispute with clients for past projects totaling around 3,800 crore. That's money they argue they're owed.
Ah, okay. And that Q1 profit jump, did that come from settling some of those claims?
Precisely. That Q1 period saw a big positive cash inflow from resolving some of those legacy disputes. They actually received 250 crore from a settlement under the government's VSV2 scheme.
VSV2, that's
Yeah.
the Vivad Se Vishwas scheme, right? The government's push to clear up these long-standing contractor payment disputes quickly.
Exactly. So it's essentially a one-off vital cash injection. It helps explain that profit turnaround, even though the core operational income was lower. Turning those old claims into actual cash is absolutely critical for their liquidity and, frankly, for market perception.
You know, we also have to mention the corporate turbulence, which probably added to the stock's volatility. The managing director and CEO recently resigned, didn't they?
They did, yeah.
That naturally creates some immediate uncertainty about management direction. For a company like this, relying on executing complex long-term projects, that kind of instability at the top can definitely make investors nervous.
Which loops us back perfectly to the valuation question. Okay, a price-to-earnings ratio, a PE of 55.0, seriously. That feels incredibly high almost. Detached from reality, given the recent drop in annual revenue and that big debt load.
Right.
Are we saying the market is basically ignoring the current operations and just betting everything on HCC collecting that full 3,800 crore in arbitration claims? Is that the whole story behind that PE?
It really looks like a major part of it. A PE of 55, plus no dividend payout right now. It strongly suggests the market isn't valuing HCC like a normal construction company based on current earnings. It's almost being treated like, I don't know, a special situation, a litigation play, where future success hinges massively on converting those old claims into hard cash. Investors seem to be pricing in huge future growth, or massive settlements. Growth that, let's be honest, the current annual performance just isn't showing yet. #OutTripRun.
So pulling all this together, what we see with HCC is a company at a really fascinating, maybe even precarious crossroads. The technical chart says consolidation, right? The market's clearly waiting. But the operational side shows they're absolutely still executing huge, vital projects and, importantly, starting to successfully turn some of those massive, long-stuck claims into actual cash, like that VSV2 money.
Yeah, so the challenge for you, the listener, the potential investor, is how you balance that. You've got the undeniable operational momentum, that proven nation-building track record, and that huge long-term gain potential. Remember, the 461% five-year return. But you have to weigh that against the immediate facts. High debt, serious volatility, leadership uncertainty, and that extremely rich PE ratio of 55. It's a company with a phenomenal past, but some pretty significant near-term hurdles and risks.
Which leads us to our final provocative thought for you to really chew on. You've got this huge bid pipeline, nearly 40,000 crore. Winning big chunks of that is traditionally what a company like this needs to break out of a consolidation phase like the one it's in. So, which matters more right now? Is the market valuing HCC primarily on the promise of that future order book?
Or is that sky-high PE of 55 simply the market betting heavily on the successful full collection of that massive 3,800 crore in disputed claims? Figuring out the answer to that question is probably key to understanding whether HCC keeps trading sideways or if it's about to start its next big move, up or down. Something to think about.